Buongiorno, grazie di essere venuti. A nome di Aberdeen, dei miei colleghi di Dambisa e di tutti quanti, vi ringrazio di essere venuti. Stiamo per partire con questa conference, The Future for Growth, quindi cercheremo di capire qual è da dove possiamo derivare, da dove possiamo catturare la crescita, che sembra essere un po' un problema non solo in Italia, ma un po' da tutte le parti nel mondo, quindi sono molto interessato, ma penso anche voi sarete molto interessati di sentire cosa e da dove possiamo crescere a livello mondiale. Ci aiuteranno per questo sicuramente Dambisa Moyo. Io mi scuso ma non ho gli occhiali, per cui cercherò di essere rapido nel leggere e anche accurato. Lei ha scritto, non solo è un'economista affermata, ha lavorato in diversi posti interessanti come la Banca Mondiale, Goldman Sachs, è una affermata scrittrice, autrice La carità che uccide, che è un libro che vi consiglio perché è molto interessante, e sta scrivendo l'ultimo, sta per pubblicare un altro interessantissimo pezzo o libro che si intitola The Winner Take All, China's Rush for Resources and What It Means for the Rest of the World, che penso sia molto interessante, per anche quello che vogliamo affrontare oggi come tema. Diciamo che sentiremo le sue parole e poi avremo una discussione moderata da Claudia Pensotti, giornalista di Class CNBC, giù in fondo. E il dibattito che lei modererà sarà tra Devan Kaloo, che è in mezzo, capo dei mercati emergenti equity di Aberdeen Asset Management, Jeremy Whitley, vicino tra Jeremy e Dambisa, che è capo della parte azionaria europea di Aberdeen Asset Management, che cresce sempre di più in interesse e importanza nel nostro gruppo, e Peter Elston, che è capo dell'Asset Allocation e Strategia per l'Asia, e tutti loro cercheranno di convincerci o di spiegarci un pochettino quello che avremo sentito prima da Dambisa. Ovviamente ognuno avrà le sue visioni e sarà un compito molto difficile per Claudia di tenerli a bada. Ma prima di questo vorrei ringraziarvi per essere venuti e lancerei un breve video di 3 minuti, quindi se la regia lo può far partire, poi ci vediamo tra un attimo. Grazie.
From London, I'm Rashad Salone.
Over to Frankfurt, where we have some news breaking.
And in London, we have
Ryan Tilker joins us from Berlin.
Francine Lacroix here to bring you the
In New York, and tell us what's driving the agenda.
Chicago, where President Obama has just...
So over to New York, where the markets are due to open in just 10 minutes.
in Hong Kong, we've got Bloomberg TV standing by.
The latest market moves. There's Zeb Eckert is standing by.
Breaking news and in-depth analysis around the clock, around the globe.
I'm here in Cannobio, Italy, a country which at the end of last year found itself at the centre of the European debt crisis. That's a debt crisis that's claimed the heads of governments in Greece, Portugal, Spain, Ireland, and yes, here in Italy with the resignation of Silvio Berlusconi last year. He was replaced by Mario Monti, who's been pushing through reform that's been designed to help economic growth rather than just relying on that German model of austerity. In the meantime, European leaders have erected firewalls. The question is whether those will provide enough protection so that some of Europe's peripheral countries can get on with rebalancing and making themselves more competitive. Another question, as European economic growth is stalling, is what about China? China exports more to Europe than any other region. Let's go to Rich Salamat in Hong Kong for more on that.
Thanks, David. The debt crisis has certainly had an impact here in China, the most evident lower exports. In January, overseas shipments actually dropped for the first time in more than 2 years. The situation is gradually improving. Exports to both the European Union and the United States have picked up in February, but the IMF believes that any deterioration in Europe could now cut China's growth rate almost in half this year. Now, the government's already trimmed this year's expansion target to 7.5%, but economists are convinced that China will actually do better than that. However, there is no doubt that economic activity is moderating, and that's partly the direct result of government policy aimed at capping property prices and repositioning the economy towards domestic consumption. Beijing has achieved part of that goal. Home sales, for instance, dropping 25% in the first 2 months of this year. That's the worst performance in over a year. But domestic consumption is nowhere near its official target. So the question is, what happens if Europe's debt crisis hijacks the government's efforts to engineer a so-called soft landing? China's leaders are playing it safe. They have plenty of regulatory ammunition in their war chest, and they're willing to use it if the economy would slow too much too quickly. Now, with inflation at a 20-month low, China's central bank can easily afford to ramp up money supply. Policymakers also have large scope for lowering the bank's reserve requirements. They're currently at 20.5% of deposits. Not to mention interest rates. They're currently held at around about 6.5% at a time when central banks globally keep borrowing costs at record lows. Now, on a global scale, any slowdown in China may well be offset by increasing momentum in the US. Margaret Brennan has more.
Rich, we are seeing signs of hope in the U.S. economy as we go into the spring season. In fact, Fed Chairman Ben Bernanke indicated as much, saying he sees that U.S. jobless rate at 8.3% as a positive sign, but not positive enough to withdraw stimulus at this point. In fact, the Fed Chairman said this week that he does believe further accommodative policy is needed to help continue to stabilize the U.S. economy. The signs of hope we've seen, the jobless rate coming down. We've also seen jobless claims asking for help from the state come down to lowest level since 2008. That statistic learned just last week. We've also seen sales of homes in the United States somewhat stabilized. Yes, not necessarily showing growth, some declines, but not significant ones. That's important as we go into the spring selling season when so many Americans try to unload their homes. So those are some positive signs in the economy and in the equity markets. We have seen the S&P 500 go through this quarter, likely to close on the quarter with double-digit gains. So there are some signs of hope, some signs of confidence going into the spring. We'll see if those green shoots, so to speak, can truly blossom. A big part of that will depend on whether Chinese economic growth continues and whether that European debt crisis can be contained.
Well, it's like seeing Italy going to China with Marco Polo and then going to the United States with Cristoforo Colombo to see where the growth will be. But Dambisa, please, can you highlight a bit for us? Thank you.
Grazie mille e buongiorno. Grazie Aberdeen Asset Management e il Salone del Risparmio. I'll go back to English now. Thank you very much for hosting me. It's wonderful to be back in Milan and to be here in Italy. I wanted to talk to you a little bit about something that I think is emerging around the world that is not really getting much focus. And this is the idea of the split or the schism that's emerging away from globalization and away from what we have known over the last several decades of a unified approach to economic growth and policy making. The title of my speech this afternoon is Where Will Global Growth Emerge? But as I go through, I will be emphasizing the idea that we are in this very vulnerable place as many nation states and many regions continue to suffer from economic stresses in a place where I strongly believe that policymakers will increasingly make choices that will move us away from globalization and towards more the idea of individual unilateral action. Let's see if I can get this to work. Yeah, there we go. So, is the US economy fixed? Is the European crisis averted? A few weeks ago, if you were watching the news, which I'm sure many of you were, you would have heard a lot of discussion about, oops, sorry. I'll get it right in a second. There we go. You'd have heard a lot about the decline in the US unemployment rate, which is there, and also the reduction in spreads in Europe, borrowing costs in Europe, and how a lot of people felt that the worst was behind us. And you just heard Ben Bernanke's comments around these unemployment figures and really tempered acknowledgement about what we see as improvements in the world economy. His exact words were really around how, even though we have seen improvements in the US unemployment situation, we still have not seen enough of growth in the employment sector for us to believe that a change has really occurred. So to the specific question, is the US economy fixed? And to the specific question, was the European crisis averted? My answer is no. Hopefully by the end of this, I'll notice. There we go. And I'm here today to talk to you about why it is that it's too early for us to celebrate. And I think fundamentally, there are two aspects of this discussion. On the one hand, there are tactical issues, things that are going on a regular basis. Things like the fact that oil prices continue to rise and are now quite sticky at a high level at $100 a barrel. But also the fact that we are now and this year looking towards a lot of political uncertainty, particularly the fact that there will be many countries this year that will be facing elections. We've just seen elections in Russia. This year, we will see elections in France. Just in a few days, we'll have the first round, which could be quite meaningful in terms of changing the policies in France. But we also expect and will have elections in the United States in November, in Mexico in the middle of the year, and more importantly, I believe, we're going to be seeing a change in the regime, political regime in China. So actually, tactically, in terms of political uncertainty, there's a lot on the agenda for this year. But I'm here to really say we should not get caught up with the tactical aspects of the global economy. These things will always emerge. What I believe is much more important are the structural factors that we continue to ignore, and I believe policymakers ignore to the detriment of the world economy. Specifically, I'm going to be talking about naked protectionism, cracks in the G20, and the strong commodity headwinds, three factors that are actually influencing the structure of the world economy. And ultimately, I believe it's these factors that will drive the economic growth and ultimately answer the question where we expect to see global growth in the next decade. Let me start with the idea of naked protectionism. Some of you might be aware that in just 1 year, October 2010 to October 2011, the European Union has recorded over 100, to be exact, 131 actions by nation governments to institute protectionist policies of trade. Now, you might think that this is relatively trivial, but in a world that is ostensibly globalized, it's this type of thing that raises the alarm bells. 1 year, 131 protectionist policies implemented around the world, primarily in developed economies. This is not to say that emerging economies are also not engaged in protectionist economies. Just 3 weeks ago, the United States and the European Union brought legal charges against China for its decision to block exports of rare earths. China, as you may be aware, produces about 95% of the world's rare earths, and these are minerals that are used in mobile phones and technology such as televisions and videos and so on. So we are seeing already just pure, outright, naked protectionism coming around the world. And of course, this week we just saw brutal and outright expropriation from Argentina in the expropriation of an asset from Spain. It's this type of thing that I strongly believe we will continue to see, particularly as Western countries continue to suffer from high unemployment and concerns about a recovery to economic growth. But it's not just issues around naked protectionism that we should be worried about. We should also be worried about the fact that as we speak, the G20 is showing cracks. And by that I mean, we're moving from a world where there were clear agendas signed up by most countries around the world into a world of unilateralism. Let me give you some examples. If you think about 2009 and the agenda around the environment and the Copenhagen Consensus, and you think about the aftermath of the 2008 financial crisis and the way the world rallied around and discussed issues of banking reform and global governance around banks through the G20. And if you look back further to 2001, you also find, you think about the World Trade Organization and the fact that countries came together to try and come up with some framework around trade. This is a very different world from the world that we live in today. We had environment, banking agreements, and we had trade, 3 pillars of economic success where we came together as a world and decided we needed to develop policies that could work. But where are we today? We have beggar thy neighbor policies. This is countries acting unilaterally to weaken their currencies so that their trade environments look more attractive than other places. And later on, I'm going to give you some quotes from Dilma Rousseff, the president of Brazil, who's been very vocal against the United States in particular, arguing that the United States is allowing the currency, US dollar, to weaken so that its trade position can improve, but this is at the expense of hurting the emerging countries, particularly the trade exporters. So we have this decision by Western countries in general, but the United States specifically, to implement policies that actually are very much unilateral and do not benefit the globe. But we also know that it's not just foreign exchange. Even in the world of fiscal policy, we are seeing changes. The most recent visit by the British Prime Minister to the United States highlighted what we already know, that there is a split between the approach that the United States has taken in the aftermath of the financial crisis, adopting a much more fiscal stimulus approach and more reduction in interest rates, as compared to the British system, which has focused on austerity. Again, both members of the G20, but taking a very different approach to the problem. And finally, if you think about trade, and I've just given you the examples of some of the naked trade protectionism that's emerging, we have actually not sat down, we as a global community, to discuss the World Trade Organization, WTO, and a possible agenda forward since 2001. All of these factors feed into this growing theme that the world is coming apart and taking a very different approach in terms of economic growth. But it's not just in trade and naked protectionism or in this whole range of factors that I've just outlined, things like fiscal stimulus and foreign exchange, where we're seeing this schism emerge. It's also in the approach to what I think is one of the biggest risks that the world is facing in the next decade, which is commodity headwinds. We all know there are going to be 9 billion people on the planet in 2050. And we also know that by 2030, which is just a couple decades away, we will have 3 billion new people in the middle class. However, the approach to solving the constraints of land, water, energy, and minerals has very much been a unilateral approach and not multilateral. I have here on the slides, very generally, the concerns or the fact that there's a growing imbalance between the demand side, which I've just touched on, and the fact that there are more binding constraints emerging on the supply side. The net effect, however, instead of us having a sit down to discuss what policies might benefit the globe as a whole, is that we have a very much unilateral approach to solving commodity headwinds. More importantly, even as I stand here today, there is not a single international body around the world that does nothing else except focus on commodity issues. And yet, we know where the price of oil is. We know that there are already 25 wars around the world today that are absolutely, have their origins in the scarcity of resources. 2 weeks ago, the United States Department of Intelligence issued a report saying that they expect that there will be significantly more wars in the coming decade that emanate particularly from water, but also from the scarcity, more generally from the scarcity of these other resources. However, nothing is being done on a multilateral basis. So back to the question at hand, where will global growth emerge? I thought I'd start off by just showing some statistics from the IMF. These are the IMF's forecasts of economic growth for 2012 and 2013. And I have highlighted the 3 regions that actually have global growth forecasted that is above 7%. Excuse me, above 5%. The reason I've done this is because 5% is really the bare minimum for many of the world economies that they need to grow at in order to meaningfully put a dent in poverty and basically to create the jobs that are needed to supply to the young population around the world. There are around 81 million people, children, who are out of work. This is between the age of 18 and 25, according to the ILO. So the point that we have to really focus on is how can we create economic growth and where can we create economic growth that can be a source of job creation. If you focus just on this, it's quite clear that the 3 regions worth focusing on are China, India, and Sub-Saharan Africa. A number of other regions, I'm afraid to say, including Italy, are forecasted for an economic contraction. I'd like to take you now back to basics, Economics 101. There are 3 key ingredients that economists focus on as drivers of economic growth. The first one is capital, which is just money. The second one is labor, which is your workforce. And the third one is this idea of total factor productivity. Just very quickly, what you really care about is both the quality and the quantity of these 3 factors. I will also point out that although we in general, outside of the economics profession, do not really talk about productivity that much, many economists think that it accounts for at least 60% of the reason why one country grows and another one does not grow. So productivity is absolutely crucial, but so are capital and labor. So let me give you a quick snapshot of where these factors lie today. Let's start with capital. Here's a picture of some figures that I'm sure you're very familiar with, looking at the debt to GDP ratio and also foreign exchange reserves. If you were to take a bet on which country is going to be able to survive the economic crisis, particularly with the need for capital, it's pretty clear that many countries have way too much debt, aside from China, but also many of these countries do not have enough money in the bank in order to sustain a blow. Many of you will be familiar with a book that came out a couple of years ago called This Time It's Different. And it's basically written by two economists, Ken Rogoff and Carmen Reinhart. And the reason this book was interesting is that it looked at 8 centuries, 800 years of economic data on what happens to a country after a financial crisis. So they looked at unemployment, they looked at economic growth, and different factors. 800 years of data. And what they found was that the debt to GDP ratios especially tends to hover around 100% of GDP after the crisis. And it can take up to a decade, 10 years after the financial crisis, for a country to get back on its feet. You can do the maths. The financial crisis was in 2008. We're in 2012, so we're 4 years in. On the basis of their analysis, we've got at least another 6 years of trying to delever and unwind the trauma that we've been through. But as I said to you, capital is not the only factor. Labor also matters. So let's have a look at what's happening on the labor side. I wanted to highlight, again, a few things that I know you're very familiar with, but what is exactly happening on the labor side? We know the big picture around pension dynamics, and I should point out that the numbers that I showed you earlier about capital are not adjusted for the pension liability. So Italy's 187 billion of foreign exchange reserves does not include the fact that there is a huge and looming pension requirement and demand, pension liabilities that will have to be paid out. And in that sense, the asset and liability duration mismatch that the country as a whole has to manage, and not just the asset managers, is enormous. But have a look at the pension dynamics. By 2040, not too long from now, 70% of US spending is going to go into Social Security and to healthcare, which is associated with retiring populations. Developed countries characterized by relatively poor age dependency ratios. Again, something you're familiar with. It will impact the bottom line, both in terms of pension costs, but also in terms of healthcare costs. Already in the United Kingdom, some 70%, in some calculations actually higher than 70% of the budget of the NHS is actually earmarked and targeted towards older populations' healthcare, so diseases that are affiliated with older populations. And then have a look at the quality metrics, because as I mentioned, it's not just the quantity, it's also the quality. Have a look at the OECD statistics at the bottom, down here. I'm hopeless at this. It's not going back. There we go. The bottom statistics on the rankings in reading and maths and science. The United States and the UK were number 1 and 2 about 15 years ago. Today, the United States is number 17 in reading, 30 in maths, and number 23 in science. China is number 1 in all 3. They've come from nowhere to get to this place. Thank you. Grazie. Finally, productivity, which you've already seen the slide, I think. There we go. Where are the biggest productivity gains? There's a lot of data on this, particularly given the European crisis, that's very focused and more drilled down. But I just wanted to give you a quick snapshot, given I have limited time here. But I think the story is pretty clear. Now, some people in the room might say, well, we expect productivity gains to be relatively slow and small in a countries that are more developed. And that is true to some extent. But you certainly do not expect this massive gap to emerge as much and as quickly as we've seen between China and the rest of the world. And as I mentioned to you earlier, if there's one factor that I think is often not really discussed in the broad media, but is actually a very, very big indicator of where growth will emerge, it's actually productivity. So based on that slide alone, my bet would be on China. Just a few more slides here. I wanted to talk to you now about where there are some risks, remaining risks in the globe. There we go. And this is really centered around what I mentioned earlier, this commodity idea, and also the concerns with regards to the tactical pressures of where we are now. The two things I want to point out is that since 2009, commodity prices have risen by 150%, and they're still rising. I spent a lot of time looking at the dearth or the scarcity of the resources that I mentioned, land, water, energy, and also minerals. And the fact of the matter is we simply do not have enough resources to cater to the new demands coming from around the world. And I also touched on the earlier figure there. I said 25 because there is one more country, Mali, which has just had a coup, which is also related to commodities. But there's a list of places where the commodity fights are going on as we speak. I want to conclude by pointing out a couple of things. And this is really the emerging markets perspective of where the world is going, once again underscoring the fact that we seem to be moving in different directions. I mentioned to you earlier that Brazilian President Dilma Rousseff wrote an article in the Financial Times, but she's also been very vocal about what's happening in the world, especially around the United States weakening their currency. And she says, economies that issue reserve currencies are managing international liquidity without a sense of the collective good. This wave of unilateral competitive devaluation creates a vicious cycle that leads to trade and exchange rate protectionism. That was September 2011. And I'm sure you're aware, about a month ago, they had the BRICS meeting. The presidents of Brazil, Russia, India, China, and South Africa met in New Delhi. And this was very much the theme that kept emerging, the idea of protectionism. And it was followed up by a visit that Dilma Rousseff made to the United States about 2 weeks ago to the White House. But the theme is very clear. They are thinking about setting up their own bank. And also there's a very strong move away from this communal discussion. Similar sentiment expressed by the Chinese Premier Wen Jiabao in October 2011. Western protectionist measures are casting a dark shadow over the world's economic recovery. I think, I'm sorry to leave you on a somber and negative point, but I don't want you to think it's just the emerging markets who are screaming blue murder. This theme is also, has also been made in the past in the United States by the former president, late President Roosevelt, in his inaugural address. And I think this is quite an important piece. Our international trade relations, though vastly important, are in point in time and necessity secondary to the establishment of a sound national economy. In reading those words, it seems to me that we are headed for a world that's moving away from globalization and into the world of every nation for itself. Thank you very much.
Grazie a Dambisa Moyo per questa presentazione. Non mancano certamente spunti di riflessione sul futuro, dov'è la crescita nel futuro. Thank you, Dambisa, for your insightful presentation. Some of these points I'm sure will come up once again as we discuss where we can find growth in the future. Now, after 4 months that have been characterized by a calming of jittery nerves by investors, we are now, just in recent days, seeing a pullback. We've given up some of these gains because some of the issues that even Dambisa mentioned are back on the table. We are seeing concerns once again about the sovereign debt crisis. We're seeing concerns about an escalating situation in Spain. And even France now seems to be on the radar. With the elections coming up next week, as she reminded, we could actually see some modifications that could change the climate even there. Chinese GDP, another issue that we may be discussing later, and of course the modest recovery in the US. These are all factors that we are considering, and we're going to talk about this with our panel. So at this point I'd like for them to talk. We have a representation of all of the geography of the world. We have Asia represented here with Peter, we have Devan with the emerging markets, and Jeremy with Europe. So it'll be interesting to hear what everyone has to say. I guess I would like to start first off, though, with Peter to give us a little bit of an overview of where is this growth, because of course it's out there. Even though with the difficult situations we are facing, there's always an investment opportunity.
Thanks, Claudia. I think at the heart of the issue here is something that both you touched on just now, but also Dambisa, which is confidence. For any economy to grow, you require confidence. Confidence of people to take risks, confidence for people to spend beyond their means. And right now we have a situation where there is a lack of confidence. The world economy over the last 30 or 40 years has benefited from certain countries being very prepared to live beyond their means, being prepared to take risks. Countries like the US, countries like the UK, Italy, I think, is an example of where people have been prepared to live beyond their means, other countries in Europe. But these countries are no longer able to provide the engine of growth. Oscar Wilde once said that people who live within their means lack imagination. And of course, he wasn't referring to economies or financial markets, but he was making a very good point. The world needs people to live beyond their means, because if you want to live within your means, you need somebody else to live beyond their means. And right now, we have a lack of people who are prepared to do that. What we're relying, of course, on is governments to provide that engine of growth. Governments are running very big fiscal deficits, but this, of course, is unsustainable. At some point, they will have to reduce their deficits. Some countries already are being forced into this. So where is the growth coming from? Asia, as Dambisa, I think, was mentioning, some countries there are in a very strong position to provide that engine of growth. The problem with Asia is that following the Asian financial crisis, they are very, very sensitive to running large current account deficits. They've been focusing on, in the last few years, on building up very strong foreign reserves, and they are not yet prepared to step in and provide that engine of growth where needed. So it will take time, I think, for government policy in Asia to change. Asian people are very frugal. We lack the safety nets in Asia, which provide people with the confidence to go out and spend. So it will take time, but potentially Asia can provide that engine of growth. There's a lot of pressure on Asian central banks to appreciate their currencies. This will, of course, in due course, provide the engine of growth that we need to take over from governments. But of course, when we talk about investing, it's not about economies, and I'm sure my colleagues here will talk about some of the companies that they manage in their portfolios.
Yes, and in fact, I would like to, at this point, go to Devan, because we spoke a little bit before coming up on stage. We were talking about how GDP growth isn't necessarily correlated with stock market growth. If you're in a country where you are seeing the growth that we're talking about, how do you decide whether to invest in their stock market, and how?
Yeah, I think absolutely. I mean, what we've seen over the last 20, 30 years in emerging markets is that quite often there's a disconnect between the macro story and the micro story, or the story about the stock markets. If you just take the example of China and Brazil, I think by any measure, if you look over the last 20 years, China has grown significantly faster than, say, Brazil. But if you look at the performance of the stock markets, the Brazilian stock markets have significantly outperformed China over that period. So for us, it's about making sure that you find the appropriate companies to invest in, because ultimately, in terms of what drives stock markets, it's about companies that make money, earn money, share that money with their shareholders. And I think in the context of emerging markets, what we find is that there's a large number of companies out there that can and are making significant money for their shareholders. But the one other point, I was just coming back to this, people having to live beyond their means and people within their means. One of the other issues, of course, within emerging markets on the macro perspective is that the problems of growth come with problems of inflation. So whenever you have strong growth coming through these emerging markets, you invariably see a very strong pickup in inflation. And inflation is a major issue for many of these countries because many of the people live at or near the poverty line. If inflation picks up, you can have a major social issue. So governments are very concerned about that. And in the recent years, what you've seen is as inflation has picked up, many of these emerging market economies have had to tighten to try and slow things down. So you've had a combination of the problems of what's happening in the West, as well as a cyclical slowdown going on in emerging markets. And that's made it quite tough. But that said, I still think within the context of emerging markets, there are some fabulous companies to invest in.
How about the geography? You know, we're talking Asia, but what are we talking about? If you can specify sort of the markets and then maybe give us an idea also of which sectors and maybe even companies or at least sectors.
Well, certainly when you look at our portfolios, the areas that we particularly favor are the more domestic-orientated sectors. And primarily that's a function of the fact that if you look at economic growth within these markets, there's a more structural theme to that. It's less cyclical, perhaps, than the more export-orientated companies that you can invest in. And it's, whether you're talking about the rise of the middle classes or the like, there's certain underpinnings to it which I think will stand us in good stead going forward. So for us, there's a lot of opportunity there. But that said, over the last few years, what we've seen is a re-rating of these sectors, and there is increasing value to be found in some of the more export-orientated sectors. I would be cautious on that. I would still favor more domestic-orientated companies, in particular some of the financials within emerging markets. I think emerging market banks are a very good way to play on this longer-term growth within emerging markets. And in recent years, they've been hit by the concerns of the global financial system, whereas they have very significant strengths and indeed opportunities to grow profits. So that would be one area we're quite keen on.
When you look at a company, how important is the dividend aspect, especially in the emerging markets? You know, in Europe, we may have a different view about how we feel. What role do dividends play there? For you, Devan.
Well, in the context of returns, there's two elements to it. There's the capital return, and of course, there's the dividends. In most emerging markets, the focus has historically been on capital returns because there's been less dividends to go about. The dividends are a function of free cash flow, and if you're in a growing economy and a growing market, you're typically using your cash flow to grow your business. But what we've seen within the context of emerging markets is that there's different areas. So there are some markets which are relatively mature, such as Taiwan or Korea, where the ratio of dividend payouts has been increasing. So you can get some very attractive dividend yields within these markets. Whereas in contrast, there are some markets which are growing very rapidly, such as Brazil, where the yields are less attractive as they're using their cash to invest. So I think it's something to focus on with regard to how you balance that. But certainly in the context of emerging markets, I would say generally it's about capital appreciation and less a dividend story.
How about China in particular, if we move to talk about this market, which is a little bit different? From that standpoint, how do you view companies that are reliant on domestic demand there versus the ones that are more tied to outside of China?
I think China is a very good example of this disconnect between macro and micro. There's a marvelous macro story, and we are certainly of the view that there's a soft landing going on in China, and they will have the wherewithal to get their way out of these problems, not least because they have the firepower to spend. They have a lot of money to throw at the problem. But that is ultimately not very good for the companies that you can invest in. Because if you have huge amounts of money being injected in the financial system, invariably it means that the cost of capital is coming down, and it means that companies are perhaps not working as hard as they should or could. It also means potentially that companies are not seeing clearing mechanisms. You know, companies that should be allowed to go bust don't go bust. So when you look at China, we find it very interesting from a macro perspective, but from a micro perspective, it's pretty hard to find things to invest in that we think are good enough for us. And in the context of China, yes, there's some very interesting domestic stories, but many of these things trade at significant premiums for the risks you're taking within that market and for the lower returns you're making in that market. So it's a market which we're a little less keen on.
Well, this brings me to Jeremy, because back to what we were saying about domestic growth versus growth from outside of your home country, that's true of many European companies. We know that now, of course, Europe, we're coming to the sticky part of this panel where Europe is certainly a question mark as to where to invest and how do we move forward in such a difficult situation where the sovereign debt crisis is really looming over our heads. We talked earlier about, you and I, about the fact that you should look at companies that are actually, companies aren't domestic anymore. Some that are actually exporting, and that's where you should be really looking.
Well, that's very, very true. I mean, you know, here we are, the poor, sick man of the world at the moment. Europe, everyone hates Europe, don't they? It's a very easy story to build in a negative way. The headlines around the world are, you know, we've got the sovereign debt crisis, and we've had huge socialization of the enormous credit boom that has taken place over the last 15, 20 years, and we, the ordinary consumer, are now paying for it ourselves. Thankfully, you know, through our governments, we have to thank for that. So I suppose the political union that was the great idea from the Treaty of Rome 1957 is now causing all kinds of difficult situations for us. But the companies that we look at, the companies that we talk to, the kind of comments we get are along the lines of, don't waste a good recession. Use it to your advantage. And the really strong companies have been doing just that. They've been releasing working capital, they've been paying down debt, they've been focusing on building barriers to entry around their industries, getting closer to the customers that they serve, and those customers are very international in nature, fortuitously. A lot of European companies have tremendous global distribution networks, which means that they are able to compete against these global companies. Those local companies, be they in Asia or other parts of Latin America, perhaps 10, 15, 20 years ago were not the strongest competitors. My goodness, they are very strong now. So you need to be in an even stronger position yourself in order to compete against them. So yes, a lot of European companies are in that position, but it's always coming down to the individual companies. There's one Swiss chocolatier called Lindt & Sprüngli, for instance, who doesn't sell anything in emerging markets at all. Its stated strategy is to build out its distribution networks in developed markets, you know, Western Europe, the US, and so on. It's that little, you know, thing that you're treating yourself, isn't it? You know, once a week you might have a nice bit of chocolate, and whether it costs €1 or €1.50, you will still pay for it. So there is pricing power. So those are the exciting things that we can find in some of these European companies.
What's your view on the European banks?
The European banks themselves. Thank you for that question. There are numerous issues in terms of the European banks. We do invest in one UK bank, HSBC, which is probably not, you know, European in nature. It's very international. It's got a 350-page annual report. It is a very complicated financial institution to investigate and to analyze. We own that. Would we invest in some of the investment banks across Europe who, frankly, will find life very difficult and complicated in terms of increased regulation? Do we, hand on heart, know exactly what their financial derivative position is? No. What will they do if they do make money in the future? Probably pay themselves before they pay their shareholders, etc. We find it easier to invest in the kind of sensible companies that we really can analyze and probably assign a valuation to and feel more comfortable doing that than the banks themselves.
I think this question of banks is an interesting one, because we, as a house, we quite like banks as a great way to generate returns from a particular economy. I think, Devan, that's the point. you made, assuming, of course, that the banks stick to what they're supposed to be doing, which is taking deposits and making sure that they're going to get paid back from their loans. In the case of China, it's a very difficult situation because, of course, the banks are not being run for the benefit of shareholders. The banks are instruments of the state. We saw that in 2009, when the global economy imploded, the government implemented fiscal policy through the banks by directing them to lend to local governments to spend on infrastructure projects. This was not for the benefit of the shareholders for the banks. This was for the benefit of China as a country. And so very difficult for us to invest in Chinese banks, but generally speaking, we quite like banks as a sector. And in fact, if you look at our Asian portfolio, we have quite a significant portion invested in banks. That may be the same for you as well, Devan. Not sure about Europe.
For Devan, it's more a consumption play and a geared play on the growth of the economy. For us, there are any number of more complicated issues than that.
You know, staying on the sector issue, Devan, what's the view on the commodities-linked sectors? We've seen, as Dambisa even pointed out and reminded us, you know, such a significant rise. What was the number? 150% rise in commodity prices in recent period. And what
actually, I think
is that aligned, or do the commodities companies behave differently than the actual commodity prices?
I think commodities are a very good example of this disconnect between making a macro call and what you can find on a micro basis. Because if you look at it macro speaking, you know, as the global growth picks up, as the emerging markets rises, there's going to be more and more demand for iron, for oil, for all of these various things. And it seems like a very simple story to get invested in. But sadly, though, that doesn't necessarily flow through to profits. Because in between all of that, you have governments, you have other shareholders, and you have obviously the difficulties of running these businesses. And one of the things that we've noticed, certainly in emerging markets of the last 5 years, is that governments have got more assertive. Now, I'm not saying whether that's right or wrong, but certainly when it comes to raising mineral taxes or royalty taxes, or taking a greater share of the profits that are being generated by these commodity companies, it is only going one way, increasingly to the government. Similarly, the cost of extraction of many of these minerals has gone up, and the competition for assets has increased. And thirdly, you've got the problem with many of these commodity companies. They are seen as national champions who have a social role to play. And their social role to play is that they have to provide local employment or local industry or what have you. And what that eventually leads to is that you have deteriorating returns on capital for these companies, and increasingly less and less profits are being shared with the shareholders, or more specifically, the minority or foreign shareholders. So while you have a very attractive story, perhaps, of growth and demand for these things and limited resources, you have perhaps a less attractive story of how you actually play that. So for us, it's a less attractive area to invest in. Much easier to buy a bank.
Can I just add something?
Certainly.
I don't know if you can hear me. It's a good point. I just wanted to add one other factor that's been quite influential in sort of exacerbating the disconnect between the commodity price rise and the lack of performance at the stock market level. If you look at gold, for example, we've seen a tremendous increase in the price of gold in the last 18 months. But if you look at all the major gold companies, so Barrick Gold, Goldcorp, Newmont, they've completely underperformed, and they've done a terrible job, really. And actually, that has had something to do with government to some extent, but is also the advent of the exchange-traded funds, so ETFs. And that's effectively become it's sort of a disruption into the way you can play in these markets. And for example, specifically about $130 to $150 billion worth of capital moved out of in capital investing into shares, so into stocks, and has moved into these exchange-traded funds. And so I think this is the sort of things that are quite interesting and that are occurring in the commodity space. And there is this big disconnect, and I think it will continue to grow. Argentina is just one example, but there are a number of countries around the world that in the past 18 months have become much tougher in terms of royalties and regulation. Australia with their mining tax, Zambia last year with royalties, Argentina, we just saw these issues around expropriation. So governments are taking a bigger chunk out of it, but also there are market factors such as exchange-traded funds.
So I think there's one other thing I'd like to say as well. Just you don't have to just think of the commodity players or the energy players. If you think of the whole sector, who is providing the services to these very large companies, who's got the technological advantage? If you think of oil, you've got to drill deeper, further offshore. The risks are that much higher. As we all know what happened with BP, if it goes wrong, it goes horrendously wrong, and the cost and the reputational damage is massive. So if you can find companies which are going to benefit in terms of providing that service to the mine, to the drill, whatever it is, then that's historically, those are the kind of companies that have made a greater return on capital over the last 15, 20 years. In our kind of analysis that we do, we think they will continue to make a greater return on capital in the future as well.
And actually, that's the only way you can play water. With land, minerals, and energy, you can trade these markets because there's a title that you can actually trade between two counterparties. The thing about water is that by and large, ultimately ownership defaults to a government. And so the only way you can really play water, trading water is as Jeremy just said, is through the service providers, the infrastructure that goes around the delivery of that. And it's not just utilities, actually. Increasingly, a lot of the companies that are delivering water, distributing water, are companies that I think are quite interesting to look at.
Dambisa, since we've started talking, I just remembered what you said a few minutes ago in your presentation. You talked about the countries, and Italy really looked horrible on all of the graphs in terms of how the expectations are for its performance, its deficit situation. And in fact, Mario Monti just yesterday did say we're not going to reach the balanced budget by 2013. He's delayed that by a year. So the concerns are there, and if you don't get growth, it's going to be really difficult to get these numbers back into order. But there is growth, as you were saying, elsewhere, and it's based on productivity. How do you put the things together in order to reach a global situation? Because if you don't pull those countries up and out, eventually in the long term, no one will benefit. I mean, how do you tie those in?
So I guess the reason I designed my presentation as it was really focused on the sort of emerging political economy where we're sort of all going into our corners and deciding to fight our own camps. I did it that way because I actually am very worried about that sort of a world. You're absolutely right. Because of globalization, I think the choice of going back into our corners and having more nation-state approach is going to be disastrous. And I think what's really necessary, but it's also the road less traveled, the more difficult road, is to stick with a global agenda. But it has to be a global agenda where there are benefits on a more equitable basis. The idea that Peter started off with, this idea of, one person benefits, I can't remember exactly how you put it, Peter, but this idea of, in order to benefit somebody else, there has to be a cost. It's almost like a zero-sum game. It's simply not tenable. And whether you will see the ramifications of that in the Arab Spring, so young people saying, you know what, we live in these countries, we see that certain regions are developing and we're not, and we will therefore take to the streets. We could see it that way, or we could see it in rising commodity prices, as I talked about. I mean, there are many of these cracks that I think we will increasingly start to see until such a time that the political infrastructure sits down and designs or adheres, more importantly, adheres to a framework that is more equitable for all. And I should give you my caveat and say that I'm actually a big-time capitalist. I believe in globalization, so I do struggle with concepts of fairness and so on. But I think that ultimately, if you think about the world that we will be living in, there will be bigger income inequality splits, that we will not be able to live in a world in that way. And so I would, to sum up, to answer your question specifically, what do I think? I really hope that we can all sit down and really come up with something. And The G20, I think, is not doing as much as it should be doing, and it's probably because the G2 essentially is what we've ended up with, and the US and China, I think, are moving further away instead of coming closer together.
Peter, we are running out of time. I did want Peter to sort of sum things up for us.
I think I'd come back to the first point I made about a global lack of confidence. I think the one flaw in the extraordinarily loose monetary policy that a number of developed country central banks are operating is that you cannot force people to spend. You cannot force people to invest. In fact, in some ways, perhaps the more you try to force people to spend, the less willing they are to spend. And so perhaps it has the opposite effect. In that sort of environment, I suspect that the global economy is going to continue to operate at a very suboptimal level, particularly when governments like the US, like other governments who've been operating very loose fiscal policy, start to have to rein in that fiscal policy. We may see things start to weaken. But in that sort of environment, you will find companies that perform very well, companies that have very strong businesses, companies that have customer bases that are more oriented perhaps to the emerging world where there is more growth. And these are the companies where they will be able to find the opportunities to benefit from the growth that we do have. So it's not all doom and gloom.
Absolutely. There are the investment opportunities out there. We do
Absolutely.
see the growth. Thank you. Thank you to Peter, to Devan, Jeremy, and also to Dambisa Moyo. Matteo?
Just a second, please. Dambisa, let me tell you one thing. Our government, after seeing your slide about our reserves, the Italian reserves, which in theory, I heard some people in the background, we have more reserves than the United States in Italy, which is a good for the audience here, so thank you for bringing it. I would also say one thing about what I said before. Italy had two persons who went to the east and to the west exploring growth, these ventures of the 1500. I think this is very similar to what our team are doing, actually. Although growth is not really everywhere and easily to be found, we have a strong team who is doing it for us. They are going and they are searching constantly the good companies to give you the good returns. So let me thank you all for this. And in Italian, the last one, sorry. Vi aspettiamo, per chi volesse, intanto vi ringrazio, ma vi aspettiamo stasera, abbiamo un aperitivo al MIB in Piazza Affari più o meno a partire dalle 6. Vi ringrazio, spero che avrete apprezzato l'apertura mentale di queste persone, di Dambisa, del fatto che siamo qui secondo anno, diciamo terza andata, terzo anno al Salone del Risparmio, siamo già diventati main sponsor dell'evento, spero che l'anno prossimo ci saremo ancora e ci sarete anche voi qua da noi. Grazie.